Being one of the wealthiest people in the world certainly does have its perks. The biggest one is that countless people will look up to you. Everywhere you go, people will be attracted to you like flies. They will be after the formula of what made you so rich. Such is the life of Warren Buffett. For the last few years, Buffett has been on the list of the wealthiest men on the planet, and for good reason. He spent his life learning and executing investment plans, bringing him a $121 billion net worth at the age of 93. So if you're starting your investing journey, we have some food for thought that you might like from Buffett himself. Today we will talk about the top 5 investment tips for all the beginners out there. And the best part is, they are all from Buffett himself. It's time to sit back and focus on what we will tell you. Because if you listen closely, you might make a lot of money. Tip number 1, never lose money. The first tip is obvious, but it brings a lot of sense to the table. Buffett's perspective may appear deceptively straightforward, yet it conceals a profound complexity. While it is evident that investors aim to capitalize on opportunities in the market, a critical path to achieving this lies in steering clear of potential losses. By judiciously eschewing decisions that expose one's portfolio to adverse outcomes, what remains is a higher probability of experiencing gains. As the adage goes, preservation of capital is paramount. This investment philosophy carries profound implications for one's approach to the market. Buffett's astute observation suggests a shift in focus. Prioritize safeguarding your investments from downturns before seeking growth opportunities. This perspective contrasts starkly with the mentality of some investors who treat the stock market as a glorified slot machine, constantly seeking the highest potential windfalls while risking substantial losses. To delve deeper into this concept, consider the idea of risk-adjusted returns. Rather than merely seeking out the investments with the loftiest potential returns, investors embracing Buffett's wisdom prioritize a nuanced evaluation of risk. They meticulously assess the downside risks associated with an acquisition, recognizing that safeguarding their capital is paramount to sustainable wealth accumulation. This approach encourages a more conservative investment strategy, emphasizing quality over quantity. Investors are prompted to seek assets with enduring value and strong fundamentals rather than speculative, high-risk ventures. While the allure of chasing quick gains remains enticing, Buffett's wisdom reminds us that the path to lasting financial success often requires patience, discipline, and a prudent aversion to unnecessary risk. Warren Buffett's deceptively simple insight serves as a timeless reminder that, in the unpredictable world of investments, avoiding loss can be just as vital, if not more so, than chasing gains. It prompts us to reevaluate our approach to the market, emphasizing a focus on sound fundamentals and a vigilant risk management strategy over the allure of instant riches. By safeguarding our capital, we ultimately increase the potential to compound gains over the long term, aligning our investment philosophy more closely with the principles of one of the most successful investors in history. Tip number 2, opportunities don't come around frequently. Warren Buffett's wisdom encapsulates a fundamental principle of investing. Seize opportunities with both hands when they arise, for they don't come about often. He paints a vivid picture with metaphorical guidance. When the heavens shower gold, be ready with a bucket, not a thimble. This advice imparts a crucial message about the importance of swift and resolute action in investments. But how does one know when the opportunity arises and when they should wait with a bucket? Buffett's counsel beckons investors to discern the moments when the stars align in their favor, akin to when stock prices plummet significantly. In such instances, where the financial odds lean heavily in your favor, the imperative is to invest boldly and abundantly. This approach recognizes that favorable prices may be elusive, emphasizing the need to seize the moment. Buffett himself masterfully applies this strategy, particularly during market downturns. He methodically accumulates substantial reserves of cash during prosperous times, a financial war chest that positions him to capitalize on opportunities when stocks take a nosedive. This cash hoard becomes his arsenal, enabling him to execute his investment maneuvers confidently and quickly. The wisdom behind this approach lies in its capacity to harness the power of timing. Investors can avoid making rash decisions or overextending themselves during bullish periods by patiently accumulating cash reserves when markets are thriving. Instead, they remain poised, ready to deploy their resources when the financial climate is most favorable for substantial returns. Buffett's philosophy underscores the importance of balance in investing. It's not solely about deploying all available resources at once. Instead, it's about having the astute judgment to recognize when the moment is ripe for substantial commitment. Discerning these opportunities hinges on a deep understanding of the market's dynamics and a keen eye for undervalued assets. Tip number 3. How to avoid loss. The Buffett Way. Buffett's investment philosophy is elegantly captured in his statement. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. This statement serves as a beacon, guiding investors beyond the mere numerical aspects of investing and highlighting the profound influence of investor behavior on market dynamics. While conventional wisdom often emphasizes the importance of crunching numbers and analyzing financial metrics, Buffett concludes that successful investing extends beyond the quantitative realm. It hinges significantly on the collective psychology of investors. When exuberance permeates the market and greed drives stock prices to dizzying heights, Buffett adopts a stance of caution and fear. He recognizes that such euphoric conditions are often precursors to market corrections or crashes, and prudence dictates taking a step back. Conversely, Buffett becomes more intrigued when a sense of panic and retreat grips the investment landscape. This is because, during such times, asset prices tend to plummet, presenting an opportunity to acquire assets at more attractive valuations. Buffett's approach pivots on the concept that when stocks are cheaper, they inherently carry lower risk levels than when they are exorbitantly priced. This core tenet underscores his strategy for mitigating losses, capitalizing on market pessimism and uncertainty to build positions in undervalued assets. A striking example of Buffett's approach in action unfolded in early 2020, when the COVID-19 pandemic sent shockwaves through financial markets. While panic and fear engulfed many investors, some, like Buffett, recognized the potential for opportunity amid the chaos. They understood that market recoveries have often followed periods of extreme distress. As others fled the market, these astute investors entered it, contributing to a remarkable and rapid market rebound from its lows. Tip number 4. Better to buy a wonderful company at a fair price than the opposite. While some value-oriented investors fixate solely on pursuing the cheapest available companies, Warren Buffett offers a more nuanced and insightful approach. He advocates for acquiring wonderful companies distinguished by superior economics and formidable competitive positions. This perspective introduces a layer of complexity because, in the investment landscape, reasonably priced companies may frequently dip into affordability, but genuinely exceptional enterprises seldom present themselves as a bargain. The crux of this approach is that companies with robust competitive advantages are eager to generate consistent profits over time. Additionally, these supporters possess the potential to rescue investors from the consequences of purchasing at elevated prices. In contrast, companies with only average attributes may plummet, failing to rebound to the purchase price or surpass it. Following this thinking, Warren Buffett has exemplified his philosophy through his long-standing investment in Bank of America. This financial institution boasts a nationwide network of branches and a highly coveted deposit franchise. As of the first quarter of 2023, Bank of America is the second-largest position within Berkshire Hathaway's investment portfolio, with a stake valued at over $29 billion. Buffett's strategic bet on Bank of America underscores his emphasis on investing in businesses with enduring strengths. By entrusting a significant portion of his portfolio to this bank, he recognizes the resilience and profitability such companies can offer over the long term. Tip number 5. It pays to be patient. Warren Buffett's renowned axiom: the stock market is a no-called-strike game. You don't have to swing at everything, you can wait for your pitch, encapsulates a profound lesson in the art of investment discernment. This quote is one of his most iconic, distilling the essence of selective opportunity recognition. It reinforces the notion that investors need not rush into every investment opportunity. Instead, they should exercise patience and discernment, waiting for the right moment or pitch, aligning with their criteria for potential reward relative to risk. Buffett's counsel is a call to prudence, encouraging investors to refrain from deploying their capital until they encounter an opportunity that piques their interest and meets their stringent standards for risk and reward. This perspective underscores the importance of diligent evaluation and due diligence in investment. Moreover, Buffett's wisdom imparts a fundamental principle: avoid exposing capital to undue risk. It echoes the idea that you need not entertain any stock that does not align with your attractiveness criteria. This approach aligns with Buffett's overarching investment philosophy, which places a premium on safeguarding capital and minimizing potential losses. Buffett's metaphorical analogy to a baseball game underscores the value of selectivity and patience in investing. Just as a skilled batter waits for the right pitch before swinging, investors should exercise restraint and discretion, only engaging with investment opportunities that resonate with their investment thesis and align with their risk appetite. In this manner, they can navigate the stock market with greater confidence and prudence, avoiding unnecessary risks and positioning themselves for the potential rewards that meet their specific investment goals. Conclusion: Warren Buffett's sage investment tips offer a roadmap for success in the financial world. His wealth of experience and timeless wisdom underscore the importance of preserving capital, seizing opportunities, understanding investor behavior, investing in wonderful companies, and exercising patience. These principles collectively shape a comprehensive approach to investing that prioritizes long-term success while minimizing risk. As Buffett himself has demonstrated through his remarkable journey, these principles are not merely theoretical. They are tried and tested and serve as a beacon for investors seeking to navigate the complex landscape of wealth creation and financial security. Whether you're a seasoned investor or just starting your journey, embracing these insights can pave the way for a more prosperous financial future.